hit a fresh one-year high of 1.39% that caused the markets to really shiver at the open. Right now, we're at 1.36%. Fed Chair Jerome Powell suggesting today before the Senate Banking Committee that while inflation is still, quote, soft, rising yields this time around are a sign of improving fundamentals for the economy. Okay, that's what he says. Let's bring in some top market watchers here and what they're really signaling for investors. Is this a gigantic flashing warning sign? I want to bring in, let's quickly speak with Tom Hayes. Tom, thank you so much for being here. Great Hill Capital's chairman. Tom, give me a sense right now of why we saw such a worrisome drop in both the NASDAQ and the Dow earlier today. And do you believe Chairman Powell that things are going to be fine?
Yeah, well, as you said, Liz, this is all about rates. You know, the 10-year yield is up 50% in the last 7 weeks. That rate of change is a little scary for managers. It's up 170% in the last 7 months, from 50 basis points to 136. And when capital is free, you get a circus of companies that are big on promises and small on profits. Now that managers are seeing that capital is going to start to cost something, they're demanding earnings and they're demanding profits. The circus is packing up its tent and moving out of town, and money is moving into cyclicals and value we've seen for the last few months. And the last few weeks, it's really coming out of the high flyer, high multiple tech stocks and the pockets of the market where there's froth. We do think this is going to persist for the next 18 months in the intermediate term. It's common in a new business cycle that rates rise, money moves into value and cyclicals. However, in the very short term, Liz, I think managers are going to want to hide out. And there are some sectors and companies that are oversold, like consumer staples. Think cereal and soup, Campbell's Soup, Kellogg's cereal. Think big pharma, Pfizer, Novartis. Think utilities, American Electric Power and Dominion. We like all of those names. We think those groups are oversold. And we think as this rate of change slows down in terms of rates, that money is going to go back into these high yielders and they're going to get a bounce in the short term.
We've just gotten Andy Brenner of Nat Alliance on the horn. You watched every single word of Powell's comments at the Federal Reserve. Andy, can the bull market that we have seen in equities survive rising rates?
No, Liz, I don't believe they can. I think that there's just too much stimulus pipeline coming in, between 1.9 trillion next week and 3 trillion, and higher rates are just going to be there. I see no reason for rates to go lower. COVID is at the end, where everyone's getting vaccinated. You know, maybe the press may not believe it, but things are getting much better. We can see a light at the end of the tunnel, and I just see no real reason. We're getting the Atlanta GDP, the last number I looked was 9.5% GDP for the first quarter. I mean, you're getting housing numbers that are off the charts. And yes, Powell did say today he's very concerned about the 10 million still unemployed. But I didn't hear anything about increasing QE. I didn't hear anything about yield curve control. And I think rates are going to get away from us. I think we'll be steady for the next couple of days, but we're going to 2% 10 years and 3% long bonds, Liz, and that's not a pretty picture considering where the Fed had been.
2%. We're at 1.36 right now, up 92 basis points over the past couple of months. As Tom just mentioned, Andy, I do have to throw you this one. You said, and this is pretty clear, that equities and this bull run that we have seen for many, many years cannot survive rising rates. Okay, then, what part of the yield curve, what are you looking at as an opportunity here, if anything? And, you know, we're looking at TIPS, Treasury inflation protected securities. And, you know, it's pretty stunning. January inflows to bond ETFs that protect against rising rates spiked $3.5 billion. I mean, to me, there's a rush and there's a change, is there not?
Absolutely, Liz. You know, inflation is coming down the pike. And yes, Paul is correct in that he's seen very little inflation over his tenure, but we're going to see much more inflation, and I think we're going to see higher rates. At some point, equities will correct, and that will mitigate the rise in rates. But I still think things are going to be in tough shape. Yes, will the bull market survive? Yes, but in the near term, we're going to have more of a correction. You moved in the last week, 1 week, from the high high of the NASDAQ to the low this morning, 8.2%. That's not a correction yet. But if you look at some of the wilder ones like Kathy Wood's ARC, in 1 week, that was down 20.4% from last Tuesday to this morning. These are the kind of severe, solid moves that you're going to get, corrections you're going to have, and there's a lot of volatility out there, and there's just too much speculation. So I think we're in for a bout of trouble.
Okay, about a trouble. Tom, you have said there are places to hide, but when do you expect, if at all, will it be a slow bottoming, a correction? Would it be a bear market for a short period of time? What can you tell our viewers to expect?
I think what you want to look for, Liz, is the rallies under the surface. I think you're going to see subdued activity in the general indices sideways to absorb the gains that we've had, and there will be opportunities on a sector rotation basis like we're talking about right now, where you can get opportunities in oversold sectors like consumer staples, like healthcare and pharma, and like utilities right now in the short term. In the intermediate term, this is a new business cycle. Having rates rise is consistent with growth, as Powell was saying today, and that value cyclical trade does best in the first 18 to 24 months of a new cycle. So we still like energy, we still like banks, we still like defense and aerospace. And two of the names that we talked about for many months with your viewers, Wells Fargo and ExxonMobil, are up 85% since November. So now they've got to take a little breather, and we've just laid out where we think you can hide in the next handful of weeks to a couple of months.
Andy, Tom, I say it felt like the markets were shivering, and now we just turned positive for the Dow. We're up 37. I just don't know how long putting these pillows underneath the stock market will work, but we shall see. Thank you both so much. And this brings me to this, you guys. If both the economy and the market